All right. Today is Sunday, July 10th. This is a recap for the stock market activities last week and an outlook for the week to come. Plus, a little discussion. Macro/Elon Musk, Twitter, you know the deal. But before we start, a few notes. Note number one, we continue to get new viewers, so I have to say this all the time. There are crypto spammers all over financial YouTube, not just this channel. We brought it up with YouTube, they did not do anything at all. I have an idea, we'll talk about that later on. But if you get a response pretending to be me with a WhatsApp number, that's not me. These are desperate crypto scammers, and they're desperate for a reason, because the tulip mania is coming to an end. So please be careful and don't provide your personal information to anybody. Note number two, because we continue to get new viewers, a lot of folks make assumptions about my stance on issues. And unfortunately, we live in this world where it's either black or white, right or wrong. There's nothing between at all. And we have the whataboutism. For example, when I criticize the current administration's economic policy, the response comes out as, what about the other guy? Likewise, when I talk about the stupidity of the war against the oil and gas industry and the misguided rush into the so-called green energy agenda, some people end up assuming that I'm anti-science, anti-climate, whatever. And of course, all of that is nonsense, but we live in this kindergarten kind of world where you have all of these brain-dead zombies who believe whatever they see and hear on TV, whatever the oligarchs and the politicians tell them. That's all there is. They have no ability whatsoever to apply critical thinking. And a result of that, a lot of folks are saying that I'm anti-climate. And here's a comment. I'm not picking on the viewer who made this comment, by the way. All of what I said is not applicable to you. I'm just saying in general. But here we have the viewer saying, for example, Maverick, could you clarify for me as to your position on climate change? Question mark. Do you think it is not happening? Question mark. Or do you think it is not related to the use of fossil fuels? Or do you think it is hopeless to do anything about it right now? I understand the strain that transitioning to renewables could have on all economies presently, but do you not see a financial and humanitarian collapse in the next decades if the changes continue in the current trajectory? Question mark. Now, I was planning to address my stance on details in the upcoming Q&A video, but because a lot of folks brought up this issue in the comments, I have to respond to it briefly right now, but I'll do that in details in the Q&A video. Here's my response in short. No, I'm not a denier. I believe in excess, in everything. And whatever you want to call it climate change, climate whatever, it doesn't matter to me. It's excess. All of a sudden we have billions of human beings. I don't believe that the world is underpopulated, as Elon Musk, for example, the subject of this video, by the way, says. I believe that the world is overpopulated. All you have to do is just go to Mumbai, India, during rush hour, and you tell me if the world is underpopulated or not. But that's beside the point. The overpopulation is not the issue in its own. The issue is everybody now wants to drive a car, wants to own a phone. All economies wants to develop, and that's within their right. But that sudden development of billions of human beings at the same time will produce excess. In this case, it's carbon. Now, my disagreement is on the solutions, the approach, and the people leading that approach. And again, I'm going to address that in details in the upcoming Q&A video. But viewers of this channel, older viewers, know my stance on the environment and all of that. And I talked in details before in previous videos about the deforestation in Indonesia and the problem with palm oil, where they chop down the forest, burn it down, and they plant these palm trees that are native to Africa in Indonesia, and they can go as far as the eye can see. You can look on the island of Sumatra, for example, from Google Earth, and you will see a stunning finding. You will see all of these palm trees for miles and miles and miles. All of that used to be forest, where a lot of precious wildlife used to live. Not anymore. And this is one of the biggest ecological problems on this planet right now. On top of that, since the proliferation of EVs on the planet, we're seeing a lot of mining of nickel in Southeast Asia. And that means chopping more forest and polluting the ocean and the coral reefs to the point where the sea turned red in Indonesia from nickel mining pollution and waste. So again, I disagree about the approach. EVs, the mining of lithium, nickel, cobalt, all of that is actually very harmful to the environment. But you don't see a lot of talk about that. And then you have these holier-than-thou oligarchs and organizations, the likes of the World Economic Forum, setting goals. By 2030, you have to do this. By 2025, you have to do this, to countries that don't even contribute to global CO2 emissions. It's minuscule. For example, what's going on in Holland right now, a country that barely contributes to CO2 emissions. Yet they don't set the same goals and targets for countries like China and India, for example. So what justifies one country having to endure economic hardship while others don't have to? And again, This is just a brief answer of my take on the issue because a lot of folks brought it up, but I'm going to talk about it a lot more in the upcoming Q&A video. Note number 3, condolences to the Japanese people on the loss of ex-Prime Minister Shinzo Abe. Of course, he's going to be remembered as the longest-serving Prime Minister of Japan. Not only that, but also Abenomics will be studied for decades to come. Note number 4, I'd like to pay tribute to actor Tony Sirico, who passed away on Friday. Of course, he played the memorable character in The Sopranos, Paulie Walnuts, which is one of the most memorable characters not just in The Sopranos, but in the history of TV. And all of a sudden, we have all of these mob actors, Ray Liotta, and then James Caan, and now Tony Sirico getting whacked one after the other by the ultimate gangster, the OG, the man upstairs.
I'm God.
But anyways, you know what we say in this program. Legends die, but memes live forever. So buckle up your seatbelts, keep your shirt on, because we got a big one today. And without further ado, here it is, in focus tonight. Pulling out. Yep, Reverend Elon Musk, the con man of the century, is going down. You have seen the rise, and now you're about to see the fall. So let's talk. We start by tracing the events as they happened. A few months ago, we got the news that Elon Musk bought about 9% stake in Twitter, and the filing was for the date of March 14th. And as you can see from the chart, Twitter caught a bid right away. And then a few weeks later, Reverend Elon Musk came out announcing that he is interested in buying Twitter. And he is making a one and final offer to buy Twitter and take it private. And he offered $44 billion, which is the equivalent of $54.20 to buy Twitter. Of course, he had to inject the 420 somehow. People thought he was joking, but he was not. He offered $44 billion to buy Twitter. We all thought it was insane. He was overpaying, but perhaps he has some original ideas to transform the platform and make it worth $44 billion, if not more. And immediately, Twitter shares popped higher during the announcement of the final offer. But there was a lot of doubt that, wait a minute, why would Elon overpay for Twitter? The company is trash. It's not worth $44 billion. So he must see something here that other folks are not seeing. Or maybe he's too high. Maybe he's on drugs. Maybe he lost his mind. Who knows? In the meantime, the announcement of the offer itself ruffled a lot of feathers. And these feathers happen to be really, really powerful entities. What are we talking about here? We're talking about the deep state. We're talking about the CIA. We're talking about the intelligence apparatus up Uranus. And the oligarchs. Lots of powerful people here had interest in Twitter. Why? Because a few years before that, they decided to weaponize all of these platforms. They colluded, that's the key word, colluded with the big tech oligarchs to make sure that they can censor, monitor, spy, create bots, steer the conversation in social media, etc., etc. And now that Elon is about to buy the entire company, he's going to open up the books. And we're going to see the secrets of Twitter and the manipulation, the bots, the twisted algos, etc., etc. And of course, the pitchforks, the long knives came for Reverend Elon Musk right away. All of a sudden, us Tesla critics, and by the way, I'm one of the biggest critics of Elon Musk and Tesla, we've been saying this company has been getting away with murder. If it was Ford, if it was GM, the regulators would have came out with the hammer against the company. But for some reason, the regulators allowed Tesla to get away with it, with occasional slaps on the wrists here and there, but that's about it. And we know why. Because your beloved politicians, your beloved colleges, the Harvards of the world, the oligarchs, all of them were invested in Tesla, and therefore they would not allow the regulators to go after the company. But magically, when Elon Musk turns out to be not one of the club, the big club that you and I are not in it, well, the club thought that Elon is one of them, and maybe he still is, but he decided to pull a move that pissed him off. And all of a sudden, the regulators are coming out of the woodwork, opening investigations that should have been opened long time ago, examining crashes that involved Tesla soufflés on the road, allowing sexual harassment lawsuits to proceed against Tesla, allowing racial discrimination suits to proceed against the company, and it goes on and on. And to be fair, while I am a critic of Elon Musk and Tesla, I defended him and I applauded him for protecting freedom of speech. He promised he would do it, and I fell for it. I supported the guy, and I made videos about it. So in other words, I'm a sucker. I fell for the trap, against my instincts, of course, because in the back of my head, I knew that this guy's the con man of the century, cannot believe anything he says. And he's always gonna look out for his end of the deal, for his benefit. He doesn't give a shit about the environment, about the planet, about you and I, about anybody. He only cares about one thing, his ego. And I should have known better. But as the talks of the Twitter deal were ongoing, a few developments happened. Number one, Elon Musk doesn't have $44 billion in cash. So he needs some collateral. He needs to borrow some money, maybe bring on some investors in the deal. And of course, he decided to dump a few shares of Tesla to fund the deal. He took margin against the company's shares, which is extremely risky move. And as you can see, the stock of Tesla went down by over 46%. What does that mean? It means that Elon Musk lost over $60 billion in paper money. The paper money that allows him to make these kind of deals of buying Twitter for $44 billion, way overpaying for the company. Well, now when the piggy bank of Tesla stock starts to go down, you become a little more careful. And you realize, in the case of Elon, that you're making a bad deal, that you're taking a lot of risk. On top of that, all of these stocks were going down anyways because the Federal Reserve is tightening the monetary policy, and we're seeing stock valuations going down, getting trimmed. So Elon puts two and two together, realized that he shot his load a little prematurely, as he does per usual, of course, and he decided to go with this cute trick of blaming the bots. Or it turns out Twitter has more bots than they initially said, and they're not being transparent about it. So Elon said, hey, the deal is on hold until we get more information, until Twitter becomes more transparent. But remember, Elon Musk made a final offer, keyword final, before doing his due diligence. This is the smartest guy in the world, by the way, the guy that you culties worship, right? But was it really about the bots? Or was it about the fact that Tesla shares went down and his power, his leverage power, went down with it? On top of that, when he talked to other investors, they said, no deal. You're overpaying, dude. What's wrong with you? You want us to fund a $44 billion deal for a trash company that is worth barely, maybe $20 billion at most? I mean, look at Twitter's financials. The revenue for Twitter last year was about $5 billion, and a lot of that is due to inflation. In regular years, Twitter makes $3.5–4 billion at most. The net income for the company last year was a loss of over $220 million. So if the company makes $5 billion in revenue and you're offering $44 billion to buy the company, you're almost paying 10 times what the company makes in sales. Now, does the company have at least a good balance sheet or good cash flow? Well, let's see. Here it is. They have liabilities of over $6.5 billion right now, and their current liabilities, the most immediate debt, is over $1.3 billion for a company that is still losing money. When we talk about the cash flow, last year it was a negative, almost $200 million. This year so far, for the TTM, the trailing 12 month, the cash flow of Twitter is negative by over $400 million. When we look at the valuations, the price to earnings ratio for the current price right now is almost 170 times, which is absurd. The price to cash flow is over 57 times, which once again is absurd. When we look at the gross margin for the company, for example, the company is not doing so good. When we look at the operating margin, it is a stunning minus 10.64. Now, remember what the operating margin means? It means out of each dollar the company makes in sales, how much does the company keep in profit from that dollar? In Twitter's case, not only they're not keeping anything, but they're actually losing over $10.50 on each dollar they make in revenue. In other words, this was a lousy deal from the get-go. No so-called business person will make this kind of deal ever, unless they slipped on a banana peel, hit their head, and lost their mind. The fair value for Twitter, in my opinion, is at around $20 a share. Elon offered $54.20 a share. That is a premium of 171%. In other words, this is the dumbest deal in history. And again, this is the guy that you people are worshipping, all of you culties. Another way we can look at the valuation and the fair value of Twitter, for example, is looking at the performance of Snapchat. Here you got Twitter in blue, you got Snapchat in yellow. Since March 14th, the date when Elon Musk announced that he bought 9% stake in Twitter. Well, since then, Snapchat went down by more than 50%, while Twitter remains positive with gains of about 11.5%. That only happened because of the premise of a deal with Elon Musk, valuing the company at $44 billion. Absent of that, the correlation between Snapchat and Twitter is extremely tight, meaning Twitter would have gone down by also 50%, if not more. If that is the case, then if Elon just shut his mouth, kept his mouth shut, he would have witnessed Twitter shares go down by 50%, the price of 16.29. And then he could have made an offer and said, hey, I'm going to buy Twitter for $20 billion. Once again, Elon shot his load a little prematurely, as he usually does, by the way, which ends up in pregnancies. So we'll see in the next few months if Twitter is going to give birth or not. But in the meantime, you know that this was a lousy deal, and this was the real reason we got the news on Friday that Elon is pulling out. It's not the bots, it's not the spam, it's not management, it's not anything else. It's the fact that he made a bad deal and now he wants to get out of it, and he's using the bots and the lack of transparency as an excuse. Matter of fact, Elon lawyers allege material breach of multiple provisions of the deal. The agreement. You mean the agreement in which you made a final offer without doing your due diligence about the company's bots and spam accounts? That's not going to go so good, but perhaps Reverend Elon Musk is pulling out of Twitter to cover up for the fact that he failed to pull out of his subordinate employees. Just a few days before the pulling out of Twitter deal, we got the news that Elon Musk fathered twins with a company executive in SpaceX, a subordinate employee. And oh, by the way, she gave birth just a few weeks ago, before his actual girlfriend Grimes gave birth to a baby boy. And he was the baby and the baby mama. Kind of cute, right? The girl, too. And now that he got caught, Reverend Elon Musk comes out and says, oh, I was just trying to save the planet by fathering babies all over the place by random baby mamas, some of whom happen to be subordinate employees to me. I was just saving the planet from the underpopulation crisis. I was just trying to save the planet with my dick. And now Vince McMahon, who just got caught paying $12 million in hush money to 4 women he allegedly sexually harassed. Even Vince McMahon is now thinking, why couldn't I think about that? I was just sexually harassing my employees to save the planet. And of course, nobody's buying this bullshit at all. I'll believe it when Elon Musk starts banging ugly fat chicks to save the planet. Then I'll say, okay, the guy's sincere. But nobody's buying this. And even if it is creepy as hell. The guy's just spreading his seeds around like Epstein. He wants to repopulate the planet with his seed. Once again, this is the guy that you're worshipping, culties. And of course, even the Big Short took a jab at Elon Musk, tweeting that babies born in the U.S. are at 1950 levels. But that does not mean the bosses should sleep around with their subordinates to try to remedy the situation. Bigger problem is nuclear families are at 1959 levels, and woke doctrine wants it lower. You gotta love the Big Short. He's not mincing any words at all. More babies in broken families, not the way. All of these baby mamas, God knows how many of them, with no father, how's that good for the planet? And this is going to be another problem because maybe this not pulling out situation was consensual, but again, who knows how many other baby mamas we're talking about here? How many other employees did Elon Musk bang and did not pull out? Because we know that he is very sensitive to his ego. Case in point, when SpaceX employees wrote a letter criticizing Elon Musk, saying that he is a distraction to the company, etc., he lashed back by firing the employees. So we have a situation here where the boss is highly sensitive to criticism and rejection. What if he approached employees and they were afraid to say no, to his proposal of saving the planet by taking his pants down? What if they were afraid of backlash? And the risk he has here, and all of Tesla shareholders have, is what if we have more skeletons in the closet of Elon Musk? But now that he got caught saving the planet, he's feeling a little ashamed, and he started to bump the child care benefits for SpaceX and Tesla employees. And he says that those benefits will go higher significantly. Well, if you care about the planet, why didn't you do that beforehand, before you started banging your employees? And the bottom line here, folks, is the following. This whole Twitter deal is nothing more than yet another pump and dump scheme by Elon Musk. And the problem this time around, if you believed Elon Musk, he pumped and dumped you, and now you're left holding the bag, but you can't even receive childcare, like the baby mamas. Matter of fact, Twitter went higher by 68, almost 68.5% since the whole charade started. And now Twitter went down since that pump by over 32%. So if you believed Elon and you bought right away, this is going to be yet another great deal by Elon. He's going to transform Twitter. He's going to make it into a $200-300 billion company. Just like he did with Tesla, you're now holding a massive bag. And guess what? There is more pain to come. Because when we look at the chart, the next Fibonacci support is down another 11% or so, and that might not even hold. And if that is the case, the stock could go down by another 45% from this point on. To the fair value, of course, of $20 a share. And while the Rev and his lawyers believe that pulling out this time around is a lot cheaper than paying child support, you just pay $1 billion fine and that's it, be careful what you wish for. This case could be the beginning of the end of Elon Musk. We witnessed the rise. This could be the beginning of the fall. Why? He's not going to get away with just paying $1 billion in fine. The pitchforks are already out for him. We all know that. And Twitter is going to argue in court. This guy gave us a final offer of $44 billion. He did not ask for any due diligence. We made decisions. We lost a lot of money based on that offer. And we're now going to seek damages of over $10 billion. Besides the damage to Elon Musk's reputation, that you cannot trust this guy at all. You cannot trust anything he says. What if he ends up paying $10 to $20 billion in fines without even getting a stake in the company? This could happen. And if it does, it will damage Elon Musk tremendously. It could be the end of this man. Because if he pays $10, $20 billion, he's going to have to sell more Tesla shares. That's going to take Tesla shares down. And by that time, maybe the market entirely is getting crashed by the Fed's policy, by the upcoming recession, and we could see this man losing hundreds of billions of dollars in net worth. Forget about child support. Forget about the baby mamas. This deal, this whole ordeal, I should say, with Twitter, could be the nail in the coffin for Elon Musk. So if you happen to be one of the culties who blindly follow Elon Musk, you might be on the ride to hell. Because if you didn't learn from the crash of Bitcoin down over 69% from the top after the pump by Elon Musk, or the crash of Doge by over 91% from the top, if that didn't teach you that this guy is a professional pumper and dumper, maybe when he finally announces that he's buying hefty bags, you'll get the point. Because we have another theory here. What if Elon Musk used the whole Twitter saga to get away with dumping billions of dollars in Tesla shares? Because if he decided to dump with no cover, people would say he doesn't believe in the company anymore. And he said that this economy is super bad, quote unquote, and the likelihood of a recession is increasing, according to Elon. So had he dumped shares without the Twitter cover, people would have said that he doesn't believe in the company anymore, and that could have exacerbated the downside in Tesla shares. That is just one theory. Whether you believe it or not, that is beside the point. But while you hold the bag in Bitcoin, in Doge, in Twitter, and soon enough in Tesla, Elon Musk is using that cash in a spending spree. The latest off is buying an $80 million private jet. And here he is, once again, the big short, questioning Elon Musk's motives from dumping billions of dollars worth of Tesla shares. According to Barry, Elon is dumping all of these shares to cover for his problems, the debt that he owes to creditors, and perhaps hush payments to who knows how many other baby mamas out there. We don't know, but Musk fired back right away, calling Barry a broken clock. But is he really? Or does Elon have a pattern of making false promises, of not delivering? Just like when he said funding secured 420, and in reality funding was not secured. He made many other false promises throughout the years. For example, in January 2017, Elon Musk announced that full self-driving Tesla cars will be ready in 6 months. In reality, fast forward to 2022, and we have yet to get a full self-driving feature in Teslas. They're still testing the feature on lab rats, aka Tesla drivers, but here's another one. March 2017, Elon Musk promised brain implants. Musk revealed that he founded a company called Neuralink to connect brains to computers. It would enable people with spinal cord injuries to walk or eventually permit human-to-human telepathy, he suggested. In 2019, Musk predicted the technology would be implanted in a human skull by 2020. What happened? Neuralink has implanted chips in the brains of a monkey and a pig. And in December 2021, Musk tweeted that progress will accelerate when we have devices in humans next year. But as of January 2022, only 2 of the 8 scientists Musk brought in to help him create Neuralink remain at the company. Why? Because allegedly the monkey got crazy and became really aggressive and did some self-harm and who knows what else. So that's not happening, at least for now. But hey, when it happens, When the brain chips become available for humans, I'd love to see the culties volunteering first. Put your money where your mouth is. And then in July 2017, Musk promised a tunnel will speed travel between New York and Washington. In reality, today the Hyperloop Tunnel project between Washington and New York is no longer listed on the company's website. The company instead opened a Las Vegas Convention Center tunnel in April 2021, and you can find videos on YouTube to see for yourself how that's working. Hint: not good. In November 2017, Musk said a Tesla semi-truck will arrive by 2019. In reality, Tesla has taken semi-orders and prototypes have been seen in testing. Musk has now committed to delivering some in 2023, so not 2019. In July 2018, Musk offers a submarine to rescue soccer team trapped in a cave. In reality, the boys were rescued by divers who carried them through the cave on stretches and did not use Musk's submarine. Some rescuers said that the tech was not practical. Another one. In April 2019, Musk announced that 1 million robotaxis will be on the road by 2020. In reality, we don't have the robotaxis yet. In November 2019, Musk said that Tesla Cybertruck to begin production in 2021. In reality, the production did not happen in 2021, and now the release date has been pushed to 2023. Another one. On May 2020, Tesla workers told it is okay to stay home during the thing. In reality, several employees said they received termination notices for failure to return to work after they took unpaid leave to protect themselves. Another one. In April 2022, Tesla humanoid robot will be ready in production by 2023. In reality, once again, this was yet another false promise. For now, Tesla has yet to show any working prototype. But besides Musk's scandals, why could this be the beginning of the end of Elon and Tesla? We're talking about Tesla stock, not the company. You see, when the thing happened back in 2020, a lot of folks stayed at home. They're not spending at restaurants, traveling, etc. We got wage inflation, all of these tech employees making loads of cash. Stimmies all over the place. The Fed is printing money like crazy. Stocks are going higher. Cryptos are going higher. Trash is going higher. Everybody feels rich, specifically the affluent class, the high-paid tech workers, etc., etc. And they want to do something with the money. Well, how about buying a nice toy? And therefore, the demand for Teslas shot up higher, significantly higher. On the other hand, with the chip shortage, with factories being shut down, with the lack of resources such as lithium, cobalt, nickel, etc., the supply chain got overwhelmed, and therefore we got an imbalance between demand and supply. Demand shot up significantly higher while the supply went down. What is the remedy for that when chips are nowhere to be found, when lithium prices are shooting to the moon? Well, you got to increase prices to dampen down that demand. But here's the problem. The demand did not go by much lower. Why? Because Tesla buyers happen to be affluent. They can afford it. Another 1,000, another 2,000, another 5,000, another 10,000, and the company will still have a substantial retention rate in demand. So Tesla decided, you know what, we're not going to be able to take that demand down, even with higher prices. But this is a once-in-a-lifetime opportunity to take advantage of the mania and sell as many cars as we can to make the company more profitable and secure a lot of cash in the balance sheet. So Tesla decided to ramp up the supply as much as possible, competing over resources by overbetting they can afford it. Their customers are not Ford customers. Their customers are not GM customers who happen to be highly sensitive to the fluctuation in pricing. Tesla customers can afford it. They don't care. And therefore, the company decided to ramp up the supply and go all in to satisfy that demand. And indeed, the strategy has been working, at least so far. Tesla managed to deliver its all-time best number of 310,000 vehicles in the last quarter. The demand is so high for soufflés. We actually have a business of flipping soufflés, not to eat them, but to make profits of them. Folks buy these cars, within a few months the price go higher, and they flip them for a profit. So far, so good for Tesla. But then there is another problem, which is the shutdown in China. And that took the supply down again because the Shanghai factories are no-go. Matter of fact, in the second quarter of this year, Tesla deliveries went down by 18% due to the China factory shutdown. And now we have talk that perhaps this is the end. Tesla's reaching the end of the road. The growth growth story that took this company to an insane valuation, maybe that story is coming to an end. And on top of that, Tesla's having problems in China. Teslas are not allowed to be parked or be near the China leadership meeting and any government-sensitive meetings and buildings because the car is equipped with cameras and recording devices. On top of that, when we talk about the supply chain woes for Tesla, the Berlin factory in Germany was shut down for 2 weeks for production problems. We're hearing more and more problems about the Austin and Germany plants that they're losing billions of dollars according to Elon Musk. And if that was not enough, the workers in Berlin, some of them happen to be union workers, they're now complaining about low wages. And therefore the factory is having a hard time finding workers. And now even German regulators are coming for Tesla's jugular. What's going to happen is the following, and this is the problem every Tesla shareholder should keep in mind. Tesla will fall into the same problem the majority of this economy will fall into, which is the fact that during the shutdowns, the lockdowns, the supply side responded to artificially inflated demand. When, not if, when the economy falls into a recession, people start to lose their jobs. All of these tech workers perhaps lose their jobs. A lot of the affluent Tesla consumers start to become more conservative in spending. Plans change. A lot of folks decide to dump their Teslas. They don't need them anymore. They want to raise cash, etc., etc. All of a sudden, you combine the fact that the factories were responding to artificially inflated demand. Once that supply hits the market, plus all the dumping from Tesla owners because they lost their job or whatever reason. To be financially conservative in an economy that is facing a recession, they dump their cars. All of a sudden, we have the inverse problem. Supply shoots up higher, demand goes down, and all of a sudden the company has to slash prices on their new cars to compete with all of the dumping in the used cars market. What does that mean? All of a sudden the margins get crushed, the growth of the company disappears all of a sudden, and this is not going to be good news for Tesla shares. And we're already seeing that. We're already seeing the financial hit in the company and the transition from capital expenditure to capital preservation in Tesla. Elon Musk is cutting up to 3.5% of the total workforce and laying off 10% of salaried staff. All of this is done to reduce expenses because margins will be crushed when the recession happens. Elon Musk is now cracking the whip on employees. If you're not going to attend the work at the office, you get a mark on your head. The boss doesn't need you anymore. The boss sees you as an opportunity to reduce cost for the company. And if that was not enough, one of the perks, the selling points of owning a Tesla or an EV in general is gasoline prices are too high. You're going to save money by buying an EV. Yet what we're seeing right now is the price of charging these Teslas skyrocketing. In the UK, the price jumped higher by 37%. It costs around £40 to fill up a Tesla. Now that's a deal still, specifically when you compare it with cars filling at the pump with these insane prices. Yet in any case, in the future, with the proliferation of EVs, the demand will rise higher, pushing the cost of charging an EV also higher. Speaking of, another headwind for Tesla is the upcoming competition. When the demand finally goes down and we see all of that supply hitting the market will be oversaturated with EVs from GM, from Ford, from Chinese manufacturers, from European manufacturers. And the prices of EVs will go down tremendously. This will crush the margin of a company that is overvalued in terms of stock price, such as Tesla. When you look at the chart right now, and this is a monthly chart, what do we see here? We see the beginning of an epic head and shoulder formation. Perhaps Tesla will catch a summer rally, forming that shoulder, but sooner or later, it's going down. And there is a possibility if we see a mass sell-off across the board, the crash, an economic downturn, combined with margin calls hitting, we could see the stock from this point on going down by over 64% to the 200s range. And that's generous. That's giving Tesla a premium versus other automobile manufacturers. And that would be a drop from the top of about 79%. Of course, the shorts, the bears, are traumatized. And they refuse to short Tesla even now when the Fed is tightening, when the risk of a recession is increasing higher, and we have the most overvalued stock in the universe. And of course, in this case, scared money will not make money. This could be the biggest single crash top to bottom in terms of market cap in stock market history. And lastly, when we talk about the rise and fall of Elon Musk, perhaps this is the beginning of the end of the man. Forget about the loss in reputation. Forget about the loss in net worth. Forget about all of that. By his political stance alone, the man managed to alienate the left entirely. Elon Musk is a boogeyman, a villain according to the left, a greedy oligarch billionaire who only cares about himself. And those people, by the way, happen to be one of the largest buyers of Teslas, the greenies and the likes, and he alienated that demographic. But he might have scored some points with the right when he talks about protecting the freedom of speech, of taking down the censorship in Twitter, yada, yada, yada. But this pull-out move will cost him dearly. Why? Because, as yours truly predicted before, the messiah of the right, Donald Trump, is now turning against Elon Musk. Da-da-da-da. Matter of fact, over the weekend, Donald Trump called him a bullshit artist. Take a look.
A mess. You know, he said the other day, "Oh, I've never voted for a Republican." I said, "I didn't know that. He told me he voted for me." So he's another bullshit artist, but he's not going to be buying.
So now we have a billionaire who lost his reputation. You cannot trust him anymore, who created so many pumps and dumps to the point where even his fans and followers are turning against him. He might be the richest man on the planet, but he's not the most powerful. And he pissed off a lot of powerful people who are now coming after him. The regulators are coming after him. Certainly the judges and courts are coming after him. The media is coming after him. And he lost any support from the left, Democrats, the liberals. And now he's about to lose support from the right too. Folks, this could be the beginning of the end of Elon Musk. I don't know how he's going to get out of this, but I can genuinely say that I feel bad for him. Anyhow, we have to move on to cover the stock market for you. We start with the performance of indices last Friday, and here we go. The Dow Industrial Average down by 46.40 points, or a decline of 0.15%. The Nasdaq was actually in the green, with gains of 13.96 points, or 0.12%. The S&P 500 was down by 3.24 points, or a decline of 0.08%. The sector's performances on Friday, flat, muted. We're not going to give any medals here. Matter of fact, trading on Friday was boring, no action at all. Yet the laggards of the day were led by materials, real estate, and industrials. Let's contrast that with the performances for the week. And here, we're going to give some medals because at number 1, capturing the gold medal, is communication services. At number 2 for the silver, consumer cyclicals, and number 3 for the bronze, technology. Meanwhile, the laggards of the week were led by energy and materials. What about the advance to decline ratios? NYSE on Friday was 39% advancing versus 56% declining. On the other hand, the Nasdaq was 52% advancing versus 42% declining. Commodities, on Friday, we saw a rebound for the most part. The short covering rally goes on. And it is becoming a little alarming for the Fed that we're getting a short covering rally, specifically in oil at this point, where it's maintaining levels above 100 for both the WTI and Brent. Both of them on Friday scored gains of over 2%, while the gasoline RBOB futures gained about a little under 1% on Friday. Muted action for heating oil, while we see natural gas down again by over 3.5%. And this is the kind of action that the Fed needs to see in crude. In natural gas, we got the short covering rally on Thursday, but the sellers did show up again on Friday. They did not show up in the WTI or Brent, and they're not showing up in grains or cotton, and this should become a little more alarming for the Fed, that even if commodities did indeed make a top, we have peak inflation in commodities, maybe, but they're not down enough, and they're rebounding higher again. When we talk about softs, lumber futures were down on Friday again, losing about 3%, but maintaining prices above 700. Likewise, cocoa was down by a little over 1.5%, yet we have cotton rebounding higher, big time, scoring gains of over 4%. Sugar also rebounding higher and gaining about 3% on Friday, yet we got muted action for both coffee and OJ futures. What about metals? Muted action for both gold and silver, but we're seeing a rebound for platinum and palladium. Look at palladium, scoring gains of over 8.75% on Friday alone. Yet on the other hand, copper is down again, losing about 1.5% on Friday. Muted to negative action for meats across the board. Live, feeder cattle futures, lean hogs, all down modestly. On the other hand, grains on Friday, we got a massive rebound across the board. Soybeans, soybean meal, soybean oil, corn, wheat. Look at wheat gaining about 6.75% on Friday alone. Oats, canola, all moving higher. The question remains, is this a continuation of the short covering rally? How long will it last? And how high will it take these futures to? Because here's the risk for the Fed. If this short covering rally encourages buyers waiting on the sidelines to say, okay, the fluff is gone, now it is the opportunity to buy commodities because we're not going to buy the dip in stocks. Commodities is the way to go. And now we see the WTI, we see not not natural gas, because natural gas will still suffer from this problem until the shutdown in the Freeport facility is resolved. But until then, natural gas will be suppressed. But we can't say the same for oil. We can't say the same for cotton or sugar or palladium or coffee or grains or even lean hogs. If these prices continue to linger higher, they don't have to go back at the top. They just have to maintain these levels right here to cause the Fed a lot of headache. Moving on to options, the big casino, what's going on here? The hottest table on Friday was Tesla. No surprise here. At around 2 million contracts traded for the name, about 54% of those were calls, and the premiums shot up higher for both calls and puts. So watch out here. We're going to talk about the chart of Tesla and talk about calls and puts in a minute. But before we do that, Apple came up at number 2 with about 1.3 million contracts traded for the name. About 55% of those were calls. At number 3, Amazon. At around 1 million contracts, about 60% of those were calls. So we're seeing finally more buying of calls, and this should, at least for now, give the market some assurance that there is sustainability, at least from a mechanical reason, behind this rally. Folks are buying more calls. We have not seen that for weeks. Is it sustainable? Are we going to see a follow-up on Monday, perhaps? If we do, then higher we go. But if all of a sudden the volume goes down again, we see buying of puts, then this was just a one-time pump for calls for whatever reason, and then down we go. But here are the unusual activities that took place in the casino on Friday. We start with the ticker TSLA, the souffle. We have calls, we have puts, big time, yet the call trade is the bigger one, so we're going to go with that. In this case, they bought the 800 calls for the expiration date of July 15th, meaning this upcoming Friday, with the expectations that Tesla could move higher by more than 6% by then. They paid around $7 a piece to enter this trade, all in all, spending around $28 million for this trade. Then you have the put trade. You can read that for yourself. But I have the ARKKKKK next for Tesla Witch Kathy Wood. Somebody's betting that the pump is over for RKK, and they're buying the 42 puts for the expiration date, August 19th, with expectations that the RKKK could go down by more than 10% by then. They paid around $2.15 a piece to enter this trade, all in all spending around $5.5 million. And then we have BABA for Alibaba. They bought calls, the 130 calls, betting for more upside for Alibaba. It's up about 60% since the bottom, and the expiration date for this trade is this upcoming Friday, July 15th, with expectations that Alibaba could move higher and score gains of over 7.5% by then. They paid around $1 a piece to enter this trade, all in all spending around $2 million. And lastly, the Qs, the Nasdaq, somebody's buying puts, fading the rip. They bought the 240 puts for the expiration date, August 19th, with expectations that the Qs could go down by more than 19% by then. More likely, this is an insurance trade. Somebody's buying insurance in case the Qs crash. They paid around $1 a piece to enter this trade, all in all spending around $2 million. Moving on to the heat map analysis for Friday. The map is all over the place. We cannot make a reasonable conclusion one way or the other, but we're seeing a lot of sectors that pumped higher, be it chips, be it energy, be it cyclicals, the reopening names, so-called reopening, all giving up some gains on Friday, and the market all in all was muted, but the sustainability of gains remains in the big caps, specifically Apple. Apple was a major winner for the week, and so was Tesla. Tesla was the winner of the day on Friday, scoring gains of 2.5%, a little over that, for the obvious reasons. The Twitter distraction is over for now, but this could get a lot uglier, as we discussed before in the program. The $1 billion settlement is not going to be $1 billion. It's going to be more than that, and that could scare Tesla shareholders again if Elon Musk needs to dump more. Now, let's contrast this map with the weekly heat map, and as you can see, lining up green, technology, chips, the big caps, specifically the cyclicals, the reopening names, travel names. In healthcare, the high-risk names, the biotech names, were the winners. So we know that this week was a growth, risk-on, buy the losers kind of week. But again, I look for the sustainability of these themes. For now, we have a sustainable negative theme in energy and materials. We know that. Commodities are down. These stocks are down too. We have a sustainable theme in the outperformance of big pharma names, the defense contractors and industrials, utilities, certain REITs, certain consumer staples, but these names were also underperformers this week. They were kind of muted, and the consistent theme of outperformance came from the big cap technology names, in my opinion, specifically Apple, Google, Amazon, Tesla, not so much for Microsoft and Meta. But what does that say? It says that we're seeing inflows. They're buying the ETFs. They're buying the losers. They're buying the Qs. And we're about to get this data perhaps this upcoming week. We'll know for sure how many billions were poured in buying the Qs, buying the dip in the big caps, and perhaps certain chip names or certain travel and reopening names. But here's the problem. If this was a mere inflow case for the first week of July, for the first week of the second half, are we going to see follow-up? Is there a fundamental case that supports this kind of inflow? For now, we do. We kind of do. We have a case we can argue with, which is commodities are down. We're seeing inflation cooling down, and therefore, why not go with the big caps, the risk-on kind of names that happen to be down a lot, offering a lot of bargains, at least on paper? But here's the problem. If yields start to move higher again for the wrong reasons, among those wrong reasons, and perhaps the most important one, is inflation expectations moving higher, but most importantly, expectations of more Fed tightening. Did we get any piece of data this week supporting more Fed tightening? Yes. That is the employment report, which came out hotter than expected, and that permits the Fed to be even more aggressive, doing a 75 basis points hike in the next meeting. And even Raphael Bostic from Atlanta supported that decision based on the employment report that we got on Friday. So watch out here. This could be another pump and dump. On the other hand, we're going to talk about the technicals in a minute. The technicals said we don't give a rat's ass for now what the employment reports say or what the expectations about Fed tightening say. Here's the counter to that. We have the upcoming CPI coming out. If the market says, I don't care about the CPI either, shake it off, then we have a massive, major technical rebound that perhaps will last throughout the summer. But I cannot say that for sure until we get the CPI out of the way. We know that the expectations of more Fed tightening are cooling down. And you know that via watching the 10-year yield. The dollar is also important to watch because that is another pulse on the Fed's policy. Moving on to the weekly heat map for the ETFs, what do we see here? The clear theme for the week is growth outperforming value. Even though value was in the green, but it was a growth kind of week. What does that mean? It means the XBI is going to outperform. It means the XLY in cyclicals will outperform. It means chips, the SMH, the SOXX will outperform. It means the XLK technology will outperform. Yet the value ETFs in financials, the XLF, XRE, in healthcare, the XLV, in industrials, the XLI, in utilities, the XLU, REITs, consumer staples, the XLP, all of these are value ETFs, and they underperformed this week. Not by a lot. As you can see, the KRE, XLF, XLV, all in the green, yet lagging the performance of growth, the risk-on kind of ETFs. When we look at internationals, muted across the board, the EWJ Japan managed to be the outperformer for the week, along with India, INDA. Now, how would Japan perform after the assassination of Prime Minister Abe? That remains to be seen. It is still sinking in. We're still absorbing the shock. We'll see how it performs, specifically the yen, this upcoming week. Now, when we talk about commodities, they were down across the board, but we have an exception in URA for uranium. And the reason is, finally, EU lawmakers are coming to their senses and they're supporting nuclear energy as sustainable. And it is sustainable. It is clean energy. And it is the only viable alternative that the European continent has right now. Nuclear energy. You cannot get gas from Russia. You can't get gas from the US. Oil is the problem. Why not go with nuclear? It's a lot better than Germany using coal again. And this was good news for the URA. Let's move on to charts, and we start with the SPY. 30 minutes chart for the S&P 500. Let's see what's going on here. In the last episode, we talked about the risk of pulling back. The question is, how bad would the pullback be? We got the answer. The answer is we got to pull back all the way down almost to 385. The market opened gapping down in the morning on Friday, but the dip buyers showed up again, and they got us all the way to the resistance at around 389.82. And the chart formed a double top formation for now, which means we could see yet another pullback. It doesn't mean that this is the end of the bounce. All what it means is there is a possibility of a pullback all the way, perhaps in a retest to 385 once again. It doesn't need to happen, but it could happen looking at the chart right now. All in all, for the bulls, the positive take is, even though the market opened gapping down in the morning, the dip buyers showed up again. This is a sign of strength, a sign that the dip buyers are here. For the bears, the good news is the chart did not make higher highs. It continues to struggle within the same resistance point at around 389.82. If that continues over and over and over again, at some point, the buyers will run out of energy, they will get scared again, and the sellers will show up and they will take this chart down. For now, the bulls still have the better argument, at least for now. Why? Because from a daily chart perspective, here is the continuous contract for the SPY, the S&P 500. The volume is still down, below average, and this is a good sign for the bulls. And we're seeing higher volume on buying, another good sign for the bulls. The momentum indicators remain positive. They're firming up. We're not seeing any sign right now as I speak that the chart is ready for any reversal whatsoever. The chart continues trading above the support of 3,855, but the bears would argue, who cares about any of that? Yes, you're making a higher low, but all of this is just a relief rally. I'll believe it when you get above 3,960, which if the chart gets there will face tough resistance. And the bears are waiting for a pullback from that point on and then losing another support. In this case, it will be 3,855, and that will initiate a shorting signal. The ultimate confirmation for the bears will be making a lower low. For now, we don't have that yet, and so far the bulls have the better argument, at least for now. Here's the SPX, a weekly chart. What's going on here? Look at the RSI. Don't pay attention at all to what's going on in the chart here. All what I want you to look at is the RSI. Every time it got this oversold, we got a bounce. Doesn't mean that this is the bottom, but it means that we could see a sustainable bounce, a legitimate bear market rally that could take us higher, and we could see that lasting throughout the summer. On the other hand, when we switch to the monthly chart, as you can see, the pain is not over yet. When we look at the RSI, the MACD indicators, they still have plenty more room to go to the downside. If they do, regardless of any rebound rally this chart about to make, it could ultimately go down to an important Fibonacci support at around 3,200. What about the Qs? 30 minutes chart. What's going on here? We got the gap down in the morning, just like we got with the SPY, but then the dip buyers showed up again. They did not get the chart all the way to 297.5, my number, but they got us to the previous high. And then the chart could not make it, and the sellers showed up again, pulling the chart down. The dip buyers, the second batch of dip buyers showed up, and ultimately by the end of the day we see a triangular pattern of consolidation, which could be resolved one way or the other. Why? Because from the bulls' perspective, the chart made a higher low in the triangular consolidation pattern. From the bears' perspective, the chart made a lower high. So both have the argument right now, but who has the better argument? I would say the bears in this case, because the RSI is showing negative divergence. Doesn't mean that the bounce is over, but it means we could see a pullback all the way to 290, 292, and then we'll see what happens from there. But don't be surprised if you wake up in the morning and you see the NASDAQ futures shooting up higher. Why? Because the daily chart for the continuous contract for the Qs is showing something else. The daily chart is more powerful, more important than the 30 minutes chart. What we're seeing here is the volume moving higher on buying days. Likewise, the momentum indicators are firming up, showing more room for the rally to go on. Yet the problem for now is the chart has a stiff resistance at around 12,207. If that's broken, then we could see a pop higher all the way to 12,766. And that would be a stiffer resistance, I would say. The bulls should hope at that point that the chart's not going to pull down aggressively, but instead it's going to consolidate. That would be a good sign, building of energy for the next leg higher. But we're not there yet, so we're not going to talk about it right now. What are the bears hoping for now? Do the bears have any argument right now? The answer is very weak arguments. The bears would say, hey, bulls, you had the entirety of the week, all of this energy, all of these inflows, and you did not make it above 12,207. This is a sign of weakness. It means sooner or later, you're going to run out of gas, and this will be yet another bull trap. Too soon for that argument. We'll wait and see what happens. But for now, the bulls have the advantage, no doubt about it. Here's the NDX, the weekly chart for the NASDAQ 100. What do we see here? Again, look at the RSI, look at the MACD indicators. We're down big, but it appears that these momentum indicators are bottoming for now, opening the room for the NASDAQ to rally higher throughout the summer. And that could take us all the way back to 1,300, even beyond that. But I would say that 1,300 will be stiff resistance. What about the IWM, the Russell 2000, with 30 minutes chart perspective? The bull flag produced a gap down as anticipated. The gap down did not take us down by much. It managed to get the chart down to the next support of 174.22. From that point on, we saw dip buyers showing up, but again forming a lower high, it holding into the support. That is a good sign, but the bad sign is the lower high. If we have a pullback and the support of 174.22 doesn't hold on, then we have the support of closing the gap around 172.25. The Dixie, the dollar index, what's going on here, daily chart, is this a topping candle? It is a negative candle for now. It is a shooting star, reverse hammer, whatever you want to call it, doesn't matter to me. The pattern says the dollar was higher and then it pulled down, closing at the lows of the day. What does that mean? Weakness? First sign of weakness? First sign for the upcoming wave of sellers? We'll see. We need a confirmation. We don't have a confirmation for now, but we know that the RSI and the MACD indicators are getting a little overextended, hence supporting that we could see the dollar down, depending on how the pound is going to perform, the British pound, depending on how the yen is going to perform, but there is a great likelihood that we could see a pullback in the dollar. If that is the case, that opens the opportunity for a trade in buying calls, betting for an upside move in gold. Gold is becoming way oversold, as you can see from the RSI. If the dollar cools down, this will be a good opportunity to trade gold higher. I'm not saying buy gold. I'm saying buy call options in gold, buy trades in gold, ride them higher, score some gains, in, out, hello, goodbye. What about Brent oil? 4 hours chart. What's going on here? We talked about the bull flag pattern, which is now playing out, and it got the chart all the way above the important resistance, now support of 105.84. If the momentum continues, there is plenty of room for the momentum to continue. The chart could go all the way to 114. That would be a stiffer resistance right there and then. If you bought crude from this point on, and you're riding a wave higher, 114 would be my target to take some profits off the table. What about the 10-year yield? What's going on here? It is moving higher again, above 3%, so watch out here. A lot of folks attributed the rally in the NASDAQ in the last week or so and the fact that yields are down. I really don't think that yields have anything to do with this. I think that we have an oversold bounce / inflows for the first half of the year. But the problem is, if the yield in the 10-year moves a lot higher, all the way back to 3.25 to 3.5. That will happen because the CPI suggests that the Fed needs to be even more aggressive. This is not going to be good for the Qs, and it could mark an end for this rebound rally. So this is one thing I'm watching for. What about the TLT? No confirmation yet. See, the MACD indicator is not showing us the green light. Maybe that will happen after the CPI, but for now, it was a bad week for the dip buyers. It is an ugly candle, erasing all of the gains for the week and then some, which means that the chart could go down all the way in a retest to the support of 109.5. What about the VIX 4 hours chart? What's going on here? We have more clarity now that this is under negative momentum, but at some point, the VIX will become oversold. Can it be oversold at around the the support of 24.29? Or we see a rebound from that point on? It could be, but again, mind you, we looked at the SPY's chart. There is a possibility of a double top at the resistance from a 30 minutes perspective, which could produce a pullback. That pullback could last intraday, and we could see hand in hand a rebound in the VIX catching a bid from 24.29. Is that going to last? Or are we going to see dip buyers buying again in the SPY? That remains to be seen. But for now, who has the upper hand in this chart? The answer is the bears, meaning SPY bulls. What about the VXN 4 hours chart? What's going on here? Again, look at the MACD indicator. We have more clarity now. We know that the VXN bears are in charge, aka the Q's bulls, NASDAQ bulls. Why? Because the chart lost 32.72 as support, but the chart is getting closer to being oversold, which could produce a bounce in the VXN and a pullback in the Q's. The question is, how long will that last? Perhaps looking at the king of the Q's, the chart of Apple, a daily chart, could shed some light here because the completion of the ABC patterns here, it got us above 145. We're getting closer to 150 right now. If the chart gets to 150 in one shot, we have to assess all other factors, yields, the Dixie, etc., but that could open the possibility of a put options trade for a pullback from 150. So 2 trades so far I'm looking at. A rebound in gold, if the Dixie indeed pulls back, and a pullback in Apple if it gets to 150 fast. What about Tesla, the souffle, 30 minutes chart? What's going on here? The bull flag is playing out. It got us almost to my number of 766.5, but are we seeing the beginning formation of a bear flag or maybe a lower high? Can we read anything into it really? Perhaps you can. The traders, the intraday traders, will read this as a topping formation from now, from a 30 minutes perspective. But even if that produces a pullback to, let's say, 730, 740, the momentum is too high right now. Look at the options market. This is going to be really, really volatile, depending on the news. And if you're on the wrong side of the trade, you're gonna get crushed. So if you happen to bid one way or the other, make sure that you book your profits right away. Always be closing when the volatility becomes too high. The bulls are not going to feel out of the woods yet until the chart recaptures another important resistance / support line. In this case, it could be 766.5. It could be closing the gap above that. But until then, I would say the bears have slightly better argument with 30 minutes perspective. But don't get too excited here, because even if the bears have the better argument, the pullback could be all the way down to 730, 725, and there is plenty of support from that point on. But what the bears are betting for is a formation of a head and shoulder. Maybe we see a rebound from 725, 730, and then that fades away. We have the head and shoulder, which could take us all the way down to 700 once again. Bitcoin, what's going on here from a daily chart perspective? Not much. The formation remains negative for now, but we're not going to short until 20,000. Better yet, 19,500. My number is violated for support. For now, when we zoom in to a 30 minutes perspective, what do we see here? We have a curved line of resistance. We're seeing multiple reactions. Watch out for any false breakouts. You're going to know that this is bottoming. If you see double bottoms, triple bottoms, then you'll know this is going to pass the curved line of resistance. But we do have excellent resistance for now, at least from a 30 minutes perspective, at around 20,450. I would rather the chart goes down there and then it rebounds higher. That would be a lot better if you're trading Bitcoin from an intraday perspective. But for now, we're going to move on to the conclusion of this video. What do we have on the economic calendar this week? On Monday, we have 3 years inflation expectations, so we have the New York Fed zombie John Williams speaking. On Tuesday, July 12, we have the Small Business Index, and we have another zombie from Richmond this time around, Tom Barkin speaking. And then on Wednesday, July 13th, we have the Consumer Price Index, the most important day of the week, CPI, along with the Fed's Beige Book. By far, Wednesday will be the most important day. And then on Thursday, July 14th, we have the PPI, the Producer Price Index. We also have Chris Waller, Governor Waller speaking. He made some statements, you might say a little too hawkish. We'll see if he doubles down. And of course, per usual, we have the initial claims for the week. And lastly, on Friday, July 15th, what do we have here? We have retail sales, another important indicator. We have import price index. We have the Empire Manufacturing Index. We also have capacity utilization. We have the University of Michigan Consumer Sentiment Index. And we have business inventories, along with another zombie from Atlanta this time around, Raphael Boystick speaking. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
Kid. Richard Kimball, the Devils, whatever. Those are all make-believe. Hey, I got no luck either. I was born, grew up, spent a few years in the Army, a few more in the can, and here I am, a half a wise guy. So what?